Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris Mcintire. Mcintire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning with your money, with your investments, for your financial future. He is president and founder of Mcintire Retirement Services, Chris Mcintire, giving us that guidance that will help to uncomplicate the financial world and make the decisions with our money a little easier to understand. Chris, no easy task in today's economic environment. We've got a lot going on, and I think people are reasonably concerned.
Yeah. And, justifiably so. So let's be honest, Peter, a lot of issues we're dealing with. And, the I word is obviously, leading into this. It brings in a certain amount of emotions. And where is the economics going as people are retiring in droves right now? Can you imagine if you were somebody that's retiring right now and your 401k just took a 20% hit? That's tough. If you had, 800,000 in your 401k, you now have 640, It
is a turbulent market, a volatile time in the economy. And really, Chris, we don't know what the future holds. And I think that is the scariest part of it. Last year, I remember the euphoria. Everybody was very excited about what their 401k and IRA and investment balance looked like. Everybody was very excited about how their home had appreciated. We've all heard the old saying, well, it's just a paper loss when things are down. But in hindsight, those were really just paper gains, because today we only have the money that current account balance shows. And unless we sold our house, we didn't take advantage of those record high prices. And we don't know where things may go from here. The market has always not only recovered, but surpassed previous highs. It's really just a matter, Chris, of how long is that going to take? And is that going to be agreeable and conducive for our timeline?
Yeah, good point, Peter. And laying this out, putting it into a perspective, like you said, makes a lot of sense. If you didn't sell your house when it was at record high prices, what difference does it make if you didn't plan on selling it anyway? Your property taxes may go up if that's been the trend in the area, and it certainly has. On the investment side of things, if you own bonds and you plan to hold them until maturity, or you've mitigated some of that interest rate risk, if you will, and shortened your bond duration, now that's just I guess you could call it a temporary pricing anomaly that you're seeing, because your statement shows you the value if you got rid of everything today. And, we have to have these conversations by the dozens with clients that are like, well, we're down this year, what's going on? I thought we were going to do this, that, or the other thing. And look, lots of things are pricing down now, bonds, stocks, many different challenges. What you see is just the value if you got out of them today. If you don't plan to get out of them today, if you're in dividend paying stocks, who cares what the price of the stock is? It's the dividend you're relying on.
There are so many factors and facets, issues and variables that are outside of our control. Today, we are going to be talking about 5 planning mistakes to avoid. These are things that can help reduce the impact of the unknown and provide a little bit more certainty, confidence, and stability into your financial future if you avoid these 5 planning mistakes. And if you'd like this report and resource of these 5 planning mistakes to avoid to go over on your own time, or to go over with a loved one, a family member, a friend, a coworker who may be thinking about and worried about retirement in this economic environment, a great resource and food for thought on what you should be doing or not doing as you plan the transition into retirement. If you'd like that, give Chris Mcintire and Mcintire Retirement Services a call. 800-868-1194 is the number to call. That's 800-868-1194, 800-868-1194. And as always, the true value of the program, the education that Chris provides here on the show, but also, and most importantly, the ability for you to get personalized and customized individual specific guidance and recommendations for your money on your financial future to achieve your important financial goals. If you'd like to sit down with Chris for a complimentary review, no cost, no obligation, a strategy session for how to plan and how to make your money work for your goals into your financial future, just give a call to that same number, 800-868-1194. That's 800-868-1194, 800-868-1194. And Chris can help review your plan, make sure that you are not making any of these 5 big financial planning mistakes to avoid, as well as spot check and review for other potential issues, problems, overexposure to risk, underperforming assets, places where your money can be working more efficiently. Again, 800-868-1194. That's 800-868-1194. Chris, number 1 on your list, not having a grip on retirement. What do you mean by grip?
Well, I like that. It's a great analogy or an acronym, if you will. Getting a guaranteed retirement income plan, Peter, guaranteed retirement income plan. Get a grip on your retirement and having it so that you have contractual guarantees through Social Security, pension plans, and annuity to cover your basic income needs. And when you get a year like this with everything up in upheaval, wouldn't it be comforting to know that, look, I've got everything covered income wise, hey, there might not be a lot of icing on the cake, but I'm not pulling money out of investments that are getting beat up right now. I've got a structured income plan. And, you may have contractual guarantees with an annuity there in one of the largest corporations on the planet, to guarantee those stream of payments. And you may have some cost of living adjustment or the way to potentially increase that income. I mean, how does that not make sense? I know folks out there might be listening today saying, well, I just don't like annuities. I'm like, well, what do? Send your Social Security payment back then and tell them, look, I don't like annuities, so you can keep the money.
Yeah, no, being a little facetious there, obviously. But Chris, I think that in times like these, that's when people most appreciate the consistency, the reliability of Social Security, of pension checks, of annuity checks. And those sources don't have the fluctuation. They don't have the risk associated with the market. It's not like just because the market is down 20 or 25% that our Social Security check is going to be cut and reduced by 20 or 25%. That reliability of consistent income, I think, is what we can base a comfortable retirement on. And I know that Social Security doesn't account for everything that most people need, but we can stack and layer and diversify and add additional streams of income to make sure that we've got enough to enjoy good times and weather bad times.
Well, yeah, think of it this way. So if Social Security is, just to keep the math simple, 50% of your needed retirement income, if you're a married couple and you both have Social Security benefits, if you don't have any sort of pension, then why wouldn't you want to add another guaranteed source of income to, maybe you cover 80 to 100% of those basic living needs. And then you can pull off of your other investments and maybe use dividends, maybe you use bond interest or growth of stocks, for example, to, help supplement that. But knowing that in the worst case scenario, I've got my monthly expenses covered through guaranteed sources of income. And so that's why we say, get a grip on your retirement. We're not here advocating that you put all of your money in an annuity or all of your money in the stock market. Again, this is part of a very well diversified, broad-based plan. We use certain types of annuities in our practice, and we don't use other types that we are personally in favor of. I'm not a big variable annuity fan. Lots of fees, expenses, the inherent risk of directly investing in the stock market there, means you have to add some layers of expenses to get some contractual guarantees. And we just believe there are safer, less expensive ways, for our clients who are retired to, create a safe bucket of money, if you will, safe from stock market risk where you can't lose anything. And man, wouldn't it be comforting to know that, through the first half of 2022, that your safe money isn't down 20% or 10% like your bond holdings might be this year? Who is that not good for, Peter?
Again, we are talking with Chris Mcintire, president and founder of Mcintire Retirement Services. If you would like to review or put together a plan for your retirement, pick up the phone and give Chris a call. He's a fiduciary advisor, putting the best interest of his clients first and foremost when structuring plans and making recommendations, and does offer the opportunity for that complimentary review and evaluation. 800-868-1194, the number to call. That's 800-868-1194. And again, today, reviewing the 5 planning mistakes to avoid for financial security throughout retirement. Number 1, not having a GRIP, a guaranteed retirement income plan on your retirement. Now, Chris, you mentioned the icing on the cake, and we've talked about dividend producing stocks. While dividends can be a fantastic source for income, they don't necessarily qualify for this GRIP, guaranteed retirement income portion of the plan, correct?
That's correct. Yeah. When we say guaranteed, we're talking Social Security, pension payments, an annuity with some contractual guarantees on it. There is no contractual guarantee with dividend paying stocks. They can certainly reduce the dividend, cut the dividend, that type of thing. So, that would be on the risk side of the category. And, nothing wrong with having money over there by any stretch of the imagination, but it would not be part of a safe strategy for us. We would put that over under the risk category, using dividends to supplement income. And we certainly do that every day for lots of clients in Northwest Ohio.
And just to back up, to define dividends, when I buy a stock, I am partial owner of that company. And over time, I hope that the value of the company itself increases and appreciates, goes up in value. That is the share price of the stock. But as the owner of a company, I also am entitled in many cases to profits that the company generates along the way. They pay out their profits in the form of dividends. However, sometimes in certain economic environments, even good companies may not be profitable. Take the 2008 Great Recession, take the COVID downturn. Good companies just weren't turning profits at that point in time, and therefore cut or eliminated some of their dividends. Chris, the thing is, when that happens, usually not only does the income get cut, but the share price has gone down simultaneously. So we don't have the capital to go out and try to recreate that same kind of stream of income either.
Yeah, you're absolutely right. Example, General Electric, used to be a great dividend paying stock. Cedar Fair, which is here in, Cedar Point Amusement Park, which is just close by behind me here, about 20 minutes, used to pay a very good dividend. And then when the pandemic hit, they cut their dividend to zero. So all of a sudden they went from an income stock to basically a growth stock. And, even as of today, they are not paying dividends yet. And, I think they're having a very good year. That may come down the road, let's hope, and that may make their stock price more attractive and bring in other investors to help grow that stock price back. So, there are inherent risk in picking and selecting quality dividend paying stocks. And, sometimes right now, after a pretty good sell-off in the stock market, you can pick up some stocks that pay dividends very cheaply, which means your yield is going up, right? Because if they were paying a 4% dividend at $100 a share, if you can buy it at 50, that's an 8% yield on the dividend.
So there are great places to include dividend producing stocks in the portfolio, but that is the icing on the cake portion of the retirement income plan, not the GRIP, not the guaranteed retirement income plan. And again, today with Chris Mcintire talking about the 5 planning mistakes to avoid for financial security throughout retirement. Number 1 planning mistake to avoid: not having a GRIP, a guaranteed retirement income plan. Taking some risk is appropriate and in many cases can be beneficial and pay off. But Chris, number 2, taking inappropriate risks with your retirement income and retirement assets is a planning mistake to avoid. Unfortunately, because the market did so well over the last decade, Chris, a lot of people were taking on more risk than was appropriate, or more risk than many people realized.
It's easy to get a little bit greedy when everything is going well and wanting to hang in there and get a little bit more. I mean, we're all human. We get it. But in retirement, some of those mistakes can be very costly. And, we deal with a lot of individuals that, somebody put a bug in their ear about, look, you need to get into cryptocurrency, for example. Well, look what's happened to crypto this year, Bitcoin, Ethereum, some of those other, high tech, fintech pieces have really been hit very hard. So, if you're going to take a risk in an outlying strategy, make sure it's not a significant amount of your retirement where, if it doesn't pan out, that, all right, you can hang in there, maybe let it recover, because some of those types of investments that you take, are going to swing pretty wildly, and you need to be able to, stomach that and say, well, all right, it didn't work out. I'm going to, instead of, because a lot of times, Peter, you'll get out it toward the bottom when that's when you need to stay in. And that's where, a lot of people, we call that capitulation right now is, boy, do we need to really abandon the strategy? It's like, nope, you probably need to hang in there now, because most people capitulate at the bottom. I forget what they call that, that behavioral concept. But if you looked at it on a chart, when the market's at real high, that's when people want to get in. When the market's real low, that's when people typically want to get out. And it should be the other way around.
I think that's called going broke. Chris.
Yeah.
But Dalbar Research Institute does a study of investor behavior and investor returns compared to the market every year. And like for the last 3 decades, 30 or 35 years, I think the history that they've conducted this study, investors on whole simply underperform the markets because they are getting in and getting out generally at the wrong times.
Yes, absolutely. They don't, and when you get a market behaving like it is in 2022, a lot of folks will want to get out, and then, all right, well, then when do you get back in? Do you get back in after it goes up 10%? It's like, but then you miss 10%. So, that's the important part of having that balanced portfolio around your risk tolerance, is to be able to allow, rebalancing of the portfolio on a quarterly basis, keep that stock bond ratio in place, which means, if your stocks have gone down and your bonds have not gone down as much, then when you rebalance, you're going to put more money into stocks when they're down in price. So that's why you have to stay in the market, and it works itself out over the long haul. Doesn't mean it makes, the first quarter or second quarter of 2022 any funner when you look at your investment statements, but you can, it's so hard to time the market, and a lot more of your success is going to be around the time you spend in it, not the timing of it.
And the direction that your money is moving also matters, Chris. The fact, when we talked about this a couple of weeks ago, the fact that when you are contributing money on a regular basis, you're actually taking advantage of downturns in the market. But if you stop, if it's just a holding pattern, a downturn is a downturn, it's no inherent advantage. But if you are making withdrawals, those same downturns that were once advantageous are now really disastrous and putting you off your trajectory, in that they lock in those losses. And that can really derail an otherwise well-funded retirement.
Yeah, no question about it. And again, that's where that rebalancing and having some tried and true discipline, will ensure your long-term financial success. having that grip on your retirement, that guaranteed retirement income plan, a well-balanced portfolio around your overall risk tolerance, that rebalancing aspect. And then I think we'll probably work our way into some taxation discussion here as well, Peter.
Indeed. Well, one final thought on this, Chris, is that taking inappropriate risks. We have, I think, been trained and sort of led to believe that taking risk equals higher returns. And if that always worked out, we would all be aggressive investors. I think that we need to sort of rewire that thinking and understand first and foremost that risk is risk and focus on that before we make a decision or lead ourselves into expectations about what our rate of return should be.
Yeah, that's a good perspective, Peter. And, an example here would be conservative investors. And, with the rising interest rates really hurt the bond market here this year. And, when you're 80% in bonds and bonds are down 10% in value and they're getting ready to hike rates here for the next several months, maybe even in an accelerated rate, you need to hang on through that ride. And once they get on the other side of that, those bond prices will bring themselves back up when they're done with this aggressive Fed policy, if you will, to stave the inflation side of things.
Okay, again, we are talking with Chris Mcintire, the 5 planning mistakes to avoid for financial security throughout retirement. If you'd like this list, or if you'd like to double check your plan to make sure that you are not relying on any of these potential mistakes that jeopardize financial security, pick up the phone and give Chris Mcintire a call, 800-868-1194. That is 800-868-1194, 800-868-1194. Number 3 on the list, Chris, the gross planning mistake. Why do we not want to make a gross planning mistake?
Well, gross planning mistake is, I want to buy a condominium in Florida and I'm going to take $100,000 out of my IRA account to do that, which may mean you need to take $125,000 out of your IRA to pay the taxes on it. And, what your gross income is versus your net income is. Can be substantial. You may get a surprise that your Medicare premiums increase because of that mistake as well. You may, get hammered on Social Security taxes as well from those big withdrawals. So, understanding where your taxable income is and, where your opportunities may lie. Do you take $75,000 out of the IRA this year and $75,000 out of the IRA next year to kind of split that up? And we get that request a lot. People say, look, should I pay my house off right now? Or, we're looking at a second home. Should I just write a check for it or should we finance it? And typically, we would say, look, why don't you finance it? And this was when interest rates were 2.5%. Why wouldn't you want to finance something at 2.5%? When the investments, when the markets and all that were accelerating more than 2.5%. So it was a much better leverage position to be in. So, it's an individual basis, understanding where people are with their taxation issues. Do they do Roth IRA conversions? Do they, take $50,000 out to buy a car when they can get 0% financing? So, a couple of different examples of, where some common mistakes are. They say, look, I don't want to be in debt to anybody. Look, you're not in debt to anybody if you financed a car at 0%, because it doesn't cost you anything and you get to keep control of your money in the meantime.
But if your entire retirement account balance, Chris, is in a tax-deferred 401k or IRA, there is actually an inherent debt there. And that's what we need to focus on with not making this gross planning mistake. We don't want to plan for retirement based on gross numbers without factoring in what is likely our largest known expense, taxation.
Yeah, you're exactly right. And net is what you get to keep. Gross is what you have to withdraw to figure out what your net is. And so, making sure that you're withholding enough taxes there so you don't get a surprise in April. And, some people don't mind getting a surprise in April when it's a surprise refund, but obviously you don't want to be on the other side of that where you have to, come up with a surprise and write a check for $5,000 to Uncle Sam. Nobody wants to do that.
And honestly, Chris, I mean, we've talked about it. Getting a $5,000 check back is also not the ideal situation tax-wise.
Yeah, it truly is. And, I'm going to inject some humor here. My dad likes to get a tax return back every year, but I don't think he tells my mom about it. So, there is that element to it as well, Peter.
Yeah, a forced savings account, I get it. You get a little windfall there if you do get that large return. But in reality, you are giving the government an interest-free loan, and you are restricting your utilization of your own money throughout the year for what could be other more impactful purposes. But regardless, either way about it, you don't want to make this number 3 out of these 5 planning mistakes a gross planning mistake. You got to factor in taxation. And unfortunately, I think, Chris, a lot of savers, a lot of investors have not had those conversations about what their retirement account is actually going to generate for them in spendable, livable income. They have not factored in the tax effects and implications. And if so, they may be missing some critical opportunities, because there are some great opportunities right now to manage and reduce or control that ultimate tax liability. So, Chris, not only if the conversation has not been had, are we missing an element, but we could be missing some impactful and valuable opportunities as well.
Correct. Yeah. And, avoiding tax sometimes is not a potential outcome, but managing taxation is something that would help prove some long-term success and put more of your own money into your pocket than, making a mistake and maybe having to, pay Uncle Sam a little bit more than what you needed to.
If you have not had those conversations, if you're worried about the tax liability that you've got with your retirement accounts, your 401ks, your IRAs, your 457s, 403bs, those tax deferred dollars do have a liability. You may have opportunities right now to control and minimize that tax implication and liability. Talk to Chris Mcintire if you have not had those conversations. Pick up the phone, give Mcintire Retirement Services a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Number 4 on the list here, Chris, not caring enough to plan for long-term care. And maybe it's not a matter of not caring. I think a lot of people kind of feel helpless about this subject when looking at their financial future, don't know what to do, and don't know the options that are available to maybe address this potential issue.
Yeah. And I think when we say long-term care here on the radio, most folks think of a long-term care insurance policy that only pays if you went into like a nursing home facility or assisted living, that type of thing. And, there are many more useful ways nowadays that we utilize different types of insurance pieces that we can use to offset that risk. I could not tell you the last time I did a standalone long-term care policy in my office. And we typically deal with somebody who's over the age of 60 in the office, as part of our, niche in the retirement business, Peter. So, there are a number of different opportunities that people should consider when trying to mitigate the risk of having to write a check for $8,000 a month to a nursing home. And, everybody listening to this radio show today that, owns a home has that home insured in case that caught fire, which has a 1 in 1,200 chance, but almost everybody listening to this radio show today does not have any insurance to pay the nursing home bill, which could be $8,000 a month. I don't get it.
Yeah. And Chris, if I can make an analogy for the way that these newer policies and approaches for long-term care work. If I buy auto insurance and I've got a $250,000 maximum deductible liability coverage, I'm paying those premium payments. I have not found an auto insurance company that if I sell my car, having never been into an accident and never making a claim, that they pay me back that benefit of $250,000 that they were protecting me with, or even that they return the premium payments that I've made to me. But in the world of this new linked benefit, hybrid, long-term care insurance, that's essentially exactly what we are getting. If we need the coverage, it's there to protect us. But if we don't ever need the coverage, there is a utilization and a return of that benefit to us. And I think a lot of people find that approach a lot more palatable than that old style that we think about with the use it or lose it long-term care insurance.
Yeah. And in almost every one of those scenarios you described, Peter, that benefit is income tax free.
Pretty nice.
What else can do that? I mean,
Absolutely.
so we try to lay that out, and we've, probably done a fair amount of that business, but it is still, I was reading today, even Peter, before our show on wealthmanagement.com that, the long-term care industry or long-term care risk is growing, not being more mitigated by people that have more than enough money to offset the risk. I mean, wouldn't you rather pay pennies on the dollar for something that may never happen versus thousands of dollars for something that did happen?
Yeah, that terminology, self-insured, I've heard that, but I don't know if most people want to spend, if they qualify to be in that kind of category, if they can state that about their financial situation. Those kind of people enjoy leverage and protection with their money as well. And to protect the assets that are giving you that confidence would be a fraction of the cost of being self-insured and having to cover those costs out of pocket. So, Chris, number 5 on this list, not using Social Security to provide effective financial security. This is a big thing, that people are rushing out and making a decision on Social Security without getting the full information, without really weighing all the options, without taking the time to run the numbers, look at the calculators, look at the projections, and really optimizing what Social Security can do for them. And oftentimes over average life expectancy, the difference is 100 to several hundreds of thousands of dollars that they're missing out on.
Yes, it truly is, Peter. It's not I turned 62 and I want to take Social Security because I retired. It's not that simple. It's, are you married? What type of Social Security or pension benefit is your wife going to have? Are they a teacher? Do they have the government pension offset or the windfall elimination provision that we have to take into account specifically here in Ohio? How long did your parents and grandparents live? What type of resources do you have to help you supplement Social Security if you weren't going to take it at 62 and maybe you waited until 65 when you get on Medicare, or 67, which would be my full retirement age. Many people listening, we have different retirement ages out there, but that's what they call your full retirement age. We have very few clients that wait until age 70 to take Social Security, only if they were, maybe a business owner, that type of thing, and they had significant revenue still coming in when they would wait until age 70. But that is not something that happens very often, Peter.
Well, again, we are talking with Chris Mcintire, Northwestern Ohio, your resource for practical information and planning strategies. If you have questions or concerns about your money, about your investments, about your financial future, pick up the phone and give Chris Mcintire a call, 800-868-1194. That's 800-868-1194, 800-868-1194. If you'd like this list of the 5 planning mistakes to avoid for financial security throughout retirement, it is a great resource to go over on your own time, by yourself, with a spouse, with a family member, a loved one, a friend, a coworker who is maybe considering retirement. Hand this one page to them that lists these 5 planning mistakes, a little information on each one, why it's important to address. They will appreciate it as well. And I promise, get something from it to ponder for their planning purposes or your planning purposes. So pick up the phone, give a call, get this list, the 5 planning mistakes to avoid. And if you've got any questions or concerns, set up that time with Chris Mcintire for the complimentary review and retirement planning strategy session. 800-868-1194. That's 800-868-1194. Chris, the time always moves by very quickly here on the program, as it does in life. That's why we don't want to procrastinate in our planning, and we always appreciate your perspective and guidance.
Yeah, my pleasure, Peter, and hope everybody has a good weekend out there. Stay safe. Thank you for listening, and God bless America.
Visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement.
The content of this radio show is
Be
provided
sure
for
to
informational
subscribe.
purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.